Welcome back again. In this class, we are going to discuss on tax GDP ratio. What is tax GDP ratio? Tax GDP ratio measures the size of a country's tax revenues compared to its gross domestic product. It is used as a measure to determine how well the government controls a country's economic resources. The ratio denotes the government's ability to fund its expenditures. The higher the tax to GDP ratio, the better the country's financial position. This helps a government become less reliant on borrowings. It gives policymakers and analysts a parameter that can be used to compare tax receipts from one year to that of the other year. The tax GDP ratio gives a more detailed picture of the country's tax revenue and taxation as a share of its output. The ratio also indicates the approach to taxation a nation uses, making it helpful in comparing its tax revenues with those of other countries. Now let us understand how do we calculate the tax to GDP ratio. The formula used to calculate the tax to GDP ratio is tax revenues of the nation during the period divided by gross domestic product of the nation, wherein the tax revenues of a country is the total amount of revenue collected by its government in the form of taxes, both direct and indirect, during a specific period of time. Gross domestic product is the total value of final goods and services produced by a country. Example of tax to GDP ratio. Consider the following data for countries A and B. The particulars are tax revenues of a nation during the period of country A and the tax revenue of a nation during the period for country B is said to be $2.50 and $4 respectively. Similarly, the GDP for country A is $15 and the GDP for country B is $20. Now let's see how do we compute the tax to GDP ratio in both the cases. So the tax to GDP ratio of country A is tax revenues of the nation during the period divided by gross domestic product of the nation. The tax revenue of the nation during the period is $2.5 trillion and the GDP of the nation is $15 trillion. So when we divide the tax revenues by the GDP, we get 16.67% is the tax GDP ratio. The country-based GDP ratio is tax revenues of a nation during a period divided by gross domestic product of the nation. So again, the revenues is $4 trillion, whereas the domestic GDP is $20 trillion. So we put together, the tax GDP ratio comes to 20%. So on comparing, country B has a better GDP ratio, tax to GDP ratio when compared to the tax to GDP ratio of country A. So this helps us to understand how well the company is able to, how well the country is able to generate its revenues to the gross domestic product. Now coming to what are the factors that affect the tax to GDP ratio. We have many income tax rates, we have exemptions, we have deductions, we have incentives. All these economic policies have an effect on the total tax collected by the government. The second important factor is the economic growth. The economic growth leads to an increased tax revenues. If an economy grows, then that leads to increased in tax revenues. The tax administration. Efficient tax collection and efforts to combat tax evasion directly impacts the tax to GDP ratio. Also, the sectorial composition. Economies with high tax sectors typically have higher tax to GDP ratio compared to those reliant on the low tax sectors. The next factor is the informal economy. We have a larger informal sector that often results in lower tax collection as many transactions are not recorded and are not untaxed. The reasons for a low tax GDP ratio in India: the presence of large informal organized sectors, greater dominance of agriculture sector. For instance, out of 25 crore households in India, 15 crore belong to the agriculture sector, which is exempted from paying tax. A higher number of disputes between tax authorities and taxpayers, with one of the lowest proportion of recovery of tax arrears. The next reason is the low tax to GDP ratio is the direct tax is to indirect tax. So our direct tax to indirect tax is 35 is to 65, which is lower than most of the OECD economies, where the ratio is 67 is to 33 in favor of direct taxes. What are the reasons for the low tax GDP ratio in India? The policies which benefited the richer private sector by providing various tax exemptions, the low per capita income and high poverty. Now let's look into the difference between national income and the per capita income. National income is the accurate yardstick of how effectively the economy is performing. It determines the level of economic activity in a country, monetary value of the final goods and services produced in a particular period. Whereas per capita income represents income per head of the population of the respective country, it means the per capita income of a geographical area indicates the total income which each person in that area earns. It gives us an idea of the average standard of living of the people. With this, we come to the end of the session. See you soon in the next session.